The price-to-earnings (P/E) ratio is a financial metric that compares a company's stock price to its earnings per share. It's a widely used valuation ratio that helps investors assess how much they are paying for a company's earnings. The formula for calculating the P/E ratio is P/E ratio equals stock price divided by earnings per share. Stock price: the current market price of one share of the company's stock. Earnings per share: the company's net earnings divided by the total number of outstanding shares. The P/E ratio provides insight into how much investors are willing to pay for each dollar of earnings generated by the company. A high P/E ratio indicates that investors are willing to pay a premium for the company's earnings, potentially reflecting high growth expectations or positive market sentiment. Conversely, a low P/E ratio suggests that the market may have lower growth expectations or concerns about the company's performance. There are two main types of P/E ratios. Trailing P/E ratio. This uses the company's historical earnings over the past 12 months. It gives a backward-looking view of the company's valuation based on its past performance. Forward P/E ratio. This uses analysts' earnings estimates for the next 12 months. It provides a more forward-looking perspective, incorporating market expectations for future earnings. Valuing stocks using the P/E ratio involves comparing the P/E ratio of the target company to those of its industry peers, as well as considering historical trends and the overall market's P/E ratio. However, it's essential to interpret the P/E ratio in context and not rely on it as the sole indicator of a stock's value. Some factors to consider include industry comparison. Different industries may have different typical P/E ratios due to varying growth rates, risk profiles, and capital requirements. It's crucial to compare a company's P/E ratio to those of similar companies within its industry. Growth prospects. High-growth companies tend to have higher P/E ratios as investors anticipate higher future earnings. It's essential to evaluate a company's growth potential and its ability to meet those expectations. Economic conditions. In times of economic uncertainty or market downturns, P/E ratios across the market might contract as investors become more risk-averse. Earnings quality. It's important to assess the quality and sustainability of a company's earnings. One-time events or accounting anomalies can distort earnings, affecting the accuracy of the P/E ratio. Certainly, finding undervalued stocks using the P/E ratio involves identifying situations where the market may have underestimated a company's potential earnings or growth prospects. Here are some strategies and considerations that can help you use the P/E ratio to identify potentially undervalued stocks. Comparative analysis. Compare a company's P/E ratio to its industry peers. If the company's P/E ratio is significantly lower than that of its competitors, it could indicate an undervalued stock. However, make sure to consider the reasons behind the lower P/E ratio, such as differences in growth rates, risk factors, and financial health. Historical analysis. Compare the current P/E ratio to the company's historical P/E ratios. If the current P/E ratio is lower than its historical average, it might suggest that the market is currently undervaluing the stock. Earnings growth. Look for companies with strong earnings growth potential that might not be fully reflected in their current stock prices. A low P/E ratio combined with a high expected growth rate could indicate an undervalued stock. Cyclical industries. Consider companies in cyclical industries that are currently facing challenges but are likely to recover in the future. Their P/E ratios might be temporarily depressed, presenting an opportunity if you believe in the industry's long-term potential. Contrarian approach. Adopt a contrarian approach by seeking out stocks that have fallen out of favor due to temporary setbacks or negative news. If the issues affecting the stock are fixable and the company has strong fundamentals, the P/E ratio might be lower than warranted. Market sentiment. Pay attention to market sentiment. If a company's stock has been oversold due to negative sentiment without a corresponding deterioration in its fundamentals, its P/E ratio might suggest an undervalued situation. Earnings quality. Assess the quality of a company's earnings. A low P/E ratio might indicate skepticism about the sustainability of earnings. If you believe the earnings are of high quality and likely to continue, this could suggest an opportunity. Dividend stocks. Look for dividend-paying stocks with relatively low P/E ratios. A combination of dividends and potential capital appreciation can enhance the overall return on your investment. Sector rotation. Keep an eye on sector rotations in the market. As investor preferences change over time, certain sectors might fall out of favor, leading to temporarily lower P/E ratios for stocks within those sectors. Risk assessment. While seeking undervalued stocks, ensure you're not disregarding potential risks. Some stocks may have low P/E ratios due to fundamental issues that warrant caution rather than investment. Remember that the P/E ratio is just one tool in your arsenal for evaluating stocks. Always conduct thorough research, consider multiple valuation metrics, and evaluate the overall market and economic conditions before making investment decisions. Additionally, while a low P/E ratio might suggest an undervalued stock, it's crucial to analyze the underlying reasons for the valuation before making any investment choices. Many famous investors use the P/E ratio as a part of their investment analysis to find undervalued stocks. While they may not solely rely on the P/E ratio, it's a valuable metric in their toolkit. Here are a few well-known investors who incorporate the P/E ratio into their strategies. Benjamin Graham. Often referred to as the father of value investing, Benjamin Graham emphasized the importance of the P/E ratio in his investment philosophy. He advocated for buying stocks trading at low P/E ratios compared to historical averages or industry peers as part of his value-based approach. Peter Lynch. The legendary fund manager Peter Lynch used a combination of quantitative and qualitative factors to identify undervalued stocks. He considered the P/E ratio as one of the metrics to evaluate whether a stock was reasonably priced compared to its growth potential and industry context. Joel Greenblatt. Greenblatt's investment strategy, outlined in his book, The Little Book That Beats the Market, involves using a formula that incorporates both the P/E ratio and the return on invested capital to identify undervalued stocks. His approach focuses on finding companies with strong earnings and attractive valuations. John Neff. John Neff, a successful mutual fund manager, used a combination of the P/E ratio and dividend yield to identify undervalued stocks. He favored stocks with lower P/E ratios than the market average and that offered attractive dividend yields. Seth Klarman. A prominent value investor, Seth Klarman considers the P/E ratio along with other valuation metrics to identify opportunities. He focuses on companies with strong fundamentals trading at a discount to their intrinsic value. Monish Pabrai. Pabrai, known for his value investing approach, uses the P/E ratio as part of his investment process. He emphasizes buying businesses with durable competitive advantages and a low valuation based on metrics like the P/E ratio. Charlie Munger, Warren Buffett's partner. Although often associated with Warren Buffett, Charlie Munger, Buffett's longtime business partner, also values the P/E ratio in his investment approach. He emphasizes a multifaceted analysis that includes qualitative factors along with quantitative metrics like the P/E ratio. It's important to note that these investors use the P/E ratio in conjunction with a range of other factors, such as earnings quality, growth prospects, industry trends, and management quality. Their investment approaches are comprehensive and require a deep understanding of the companies they invest in. Well, that's it for this video, and thank you for watching. For more videos like this, please like and subscribe to this channel. Until next time, happy investing!